If you are a dividend investor, you probably came across Starbucks as one of the most stable dividend growth companies in the stock market, especially coming from the US. But is this situation going to last? In this video, I'm going to take you through a fundamental and technical analysis of the legendary coffeehouse company with the key question in mind. Is Starbucks a safe dividend investment company, or is it a value trap? Stay tuned, as I'm going to show you at the end of the video a trick that I have to generate extra income while waiting for the dividend to hit my account. For the past year or so, the Starbucks stock has been hovering around the $75 to $115 range, with the Fibonacci retracement showing that the company has been hovering around the 0.5 to the 0.618 critical retracement levels. Starbucks has a significant payout ratio of above 200%, partially explained by the divestiture from China and the transformation of their own stores into a licensing business. Their dividend history has been lackluster, with a dividend growth of more than 10% over the past 10 years, but a huge deceleration over the last couple of years with an only 4% increase in the past increase from the company. So how is Starbucks trying to turn around this situation? Its new CEO, Brian Niccol, who joined the company in end of 2024, has created the strategy called Back to Starbucks. He's saying to his shareholders that we are not finished with our Back to Starbucks plan and our broader transformation. This transformation entails decreasing the number of stores in the US, transforming his business in China into a licensing store, and bringing back people into the stores that they can increase the average revenue per customer at the Starbucks stores. And truth be told, the turnaround is starting to take hold. What you can see here is the stabilization of the comparable store sales in the US, which is by far their key market, and a slight increase in the international sales at plus 3%. The company communicates on continued investment in and scale of the Green Apron service, basically hiring more workers to deliver better customer service, delivering a great customer experience in coffee houses by welcoming and connecting with the communities to bring back Starbucks in the middle of culture, and also very simply adding more plugs so people can plug their devices, phones, laptops, etc., so they can spend more time at the Starbucks stores. And they also plan to drive stronger customer engagement through marketing and menu innovation, for example, in the protein space. But is this going to be enough to turn around the situation for the coffee giant? Truth be told, the stock performance have been lackluster compared to the S&P 500, the Nasdaq, and the consumer discretionary portion of the S&P 500 that have at least increased by 50%, if not more than doubled, while Starbucks stock has basically stayed flat over the past 5 years, increasing only from a basis of $100 to about $110 in the last 5 complete years. So this is not a good news for the company and something to definitely watch out for in the future. The company's restructuring and deleveraging efforts since the Back to Starbucks strategy started has included an $892 million impact on its operating income, dampening its ability to pay a dividend and to buy back shares, which is not good news for short-term or long-term investors. An additional major step taken by Starbucks is to form a joint venture to mark the next chapter of its growth in China. They are basically going to sell 60% of their stake in their Chinese business and license it to the Boyu Capital joint venture company. This means that Starbucks will not have to manage their stores as much anymore in China, and that they will not have to face direct competition from the local players that have been eating its market shares for years. Good news for the company that will be collecting a fee from the licensing, but a big question about how much of that cash that they generated and they freed from the China will be used to save its situation in the US and keep growing internationally. Another step taken by Starbucks is to keep innovating in its drink business and offer new solutions to consumers that have been looking for other brands. For example, they have been offering more protein options as well as sugar-free drinks. And the company is also rethinking its coffee experience and investing massively into its workforce. So what's my position on Starbucks? I currently own 100 shares of the company at an average cost of $96.49. The current dividend yield on my portfolio is 2.68%, and I benefit from the growth of 4.71% over the past 3 years. I am pretty confident that the company can turn around its situation, but additionally to having 100 shares and collecting dividends, I also collect additional income by selling covered calls on Starbucks. Despite being in the consumer discretionary sector and not being in the tech sector, which is usually more volatile, the company has been offering pretty good yield for its sector, partially because the market thinks that it's slightly overpriced at a 40 PE ratio that is higher compared to its competitors like a Yum Brands or a McDonald's that are more around the 25 PE ratio. But situation is I can sell monthly calls on Starbucks whenever the stock price is slightly above or slightly below my average cost, and usually I manage to make between 1 to 2%, sometimes 3% yield on my investments. So this is very good for me because the average yield over a year is about 2.5 to 3%, but I managed to make between 1.5%, let's say, and 2.5% every month by selling covered calls. Usually my expiration is between 30 days and 40 days, depending on the strike price, depending on the current price of the stock. For example, here, if I want to sell a covered call and go back to my cost basis of 96, I would be collecting between $240 and $320 in income. A very good way to generate additional income, reinvest in the company if I do not need the cash, or reallocate it into other stocks to increase my snowball effect by reinvesting into other dividend paying stocks or by investing into dividend paying ETFs. So what do you think? Is Starbucks a buy, a hold, a sell? Let me know what you're doing in the comments if you're interested in Starbucks as a dividend company or as an option play. And if you want to know more about how I generate income additionally to my dividends using other stocks, check out this video about option selling on Qualcomm. Thank you for watching. Leave a like, subscribe, leave a comment, and I'll see you in the next one. Bye-bye.